Welcome to Griffonomics, where we conduct financial investigations to define the risk before we look at the reward. Today we're diving into Amentum Holdings, Inc., trading under the ticker AMTM. Amentum is executing a deliberate, highly profitable corporate transformation that prioritizes margin quality over volume, intentionally shedding low-margin pass-through contracts to pivot its workforce toward high-value nuclear engineering, space systems, and edge AI infrastructure. However, this strategic pivot creates a structural tension, temporarily flattening top-line revenue growth while creating an elite free cash flow compounding engine.
Yeah, it really is this profound shift. I mean, we are watching a legacy giant just fundamentally rewire its DNA. They're moving away from being the sheer volume player, to focus intensely on specialized high-yield engineering.
Right, and for you listening, our mission today is to really peer beneath the noisy headline revenue numbers of Amentum's Q3 fiscal year 2026 earnings. We want to uncover the actual mechanics of this transformation.
Because if you just read a surface-level headline, right, one that says Amentum lowers revenue expectations, you might completely misunderstand the financial engine they're actually building.
Exactly, you'd miss the whole story.
And that is the core of the issue here. Because for anyone watching the infrastructure or defense or, well, the AI energy sectors, Amentum is like the perfect case study. It shows exactly why you can't simply look at top-line revenue growth to judge a company's health.
You have to look at the margins.
Exactly. To understand the actual financial power being generated, you have to look at the quality of those profit margins.
So before we get into the massive nuclear and AI projects, let's look at the mechanical proof in their recent earnings audit. Because those Q3 numbers tell a very specific story about profitability, don't they?
They really do. So let's break down those Q3 figures for you. Amentum's Adjusted EBITDA margins, which is essentially a measure of the pure cash profit generated by their core operations, expanded by 60 basis points year over year.
Wow, 60 basis points.
Yeah, that brings them to a record 8.3%. And in the massive scale government services and infrastructure space, pushing past an 8% margin is exceptionally difficult. It's not an accident.
Right, that takes real effort.
It does. And this drove a 20% year-over-year surge in their adjusted diluted earnings per share, which landed at 67 cents.
Okay, wait, let's unpack this. If their overall revenue is slightly shrinking, how are they mechanically expanding that profit margin so significantly? How does the math work there?
So the math really comes down to a deliberate contract mix shift. It's specifically driven by really strong operational execution in their digital solutions and global engineering solutions segments.
Correct.
See, historically, the bedrock of government contracting was the cost-plus model. In a cost-plus contract, the government reimburses a company for all its expenses and then tax on a small, predetermined percentage fee as profit.
Which sounds safe, right?
It's totally financially safe, but the margins are just razor thin. And crucially, there is zero financial incentive to be efficient. So Amentum is aggressively moving away from that. They are pivoting toward technology-enabled, firm, fixed price contracts.
I want to make sure we really understand how that actually changes the math for them. Let's say I'm a mechanic and the government asks me to fix a fleet of trucks. In the old cost-plus model, if I take 10 hours to fix a truck, I get paid my hourly rate plus like a tiny profit margin, say $50.
Correct. But in the new firm fixed price model, the government just says, well, we will pay you $500 total to fix this truck.
Oh, I see.
Yeah, so if Amentum deploys an advanced diagnostic AI tool, the technology enabler, right, and fixes that truck in just 2 hours instead of 10, they still get paid the full $500.
So they pocket all the savings from their own efficiency.
Exactly. That is the engine behind that 60 basis point margin expansion. They are being directly rewarded for operational efficiency now.
That makes perfect sense. And we also have to factor in their balance sheet maneuvers here because they achieved significant interest expense savings.
Massive savings.
Over the trailing 12 months, they've made almost $700 million in total debt repayments. And in Q3 alone, they made a $125 million voluntary principal payment on their term loan B, which is essentially a large block of institutional debt.
Yeah.
They just paid that down early.
Which is a brilliant maneuver in a higher interest rate environment. I mean, when you combine the higher operational margins from those fixed price contracts with a significantly lower interest burden, thanks to those aggressive debt paydowns and a very successful credit facility refinancing, your earnings per share are naturally going to surge, even if the top-line revenue is totally flat.
You know, it makes me think of Amentum's strategy like a chaotic, crowded restaurant. The owner decides to take all the cheap, high-volume, low-margin items off the menu, like the $10 burgers and fries, just to focus entirely on serving high-end, perfectly cooked steaks.
I like that.
Right, so now, the total number of customers walking through the door, the top-line revenue drops. The restaurant looks less busy from the street, but the actual cash going into the owner's pocket at the end of the night absolutely skyrockets.
The restaurant analogy is a great starting point, but I take it even further. It's not just changing the menu. It's, utilizing new kitchen technology so you can serve those high-end steaks with half the kitchen staff. That fixed price, tech-enabled model changes the fundamental physics of their business.
That is a huge distinction. But hold on, if they are printing cash and margins are up, why did management just tell Wall Street they're going to make less money this year?
Yeah.
Let's talk about the glaring disconnect here. There is this massive backlog of work, but management actually revised their full-year revenue guidance downward.
The backlog paradox here is absolutely fascinating. Let's just look at the sheer scale of the numbers for a second. Amentum currently boasts a $48.2 billion total backlog.
That is a staggering number.
It is. And to put some teeth on that, their funded backlog, which is the money explicitly appropriated and obligated by the government, that jumped 10% year over year to $6.2 billion. Plus, they have a trailing 12-month book-to-bill ratio of 1.3 times.
Wait, let me stop you there. So if the book-to-bill is 1.3, mathematically, for every dollar of revenue they bill out and finish, they are booking $1.30 in new business.
Precisely.
So they are filling the bathtub significantly faster than the drain is emptying. Why is that a paradox?
Well, because despite that overflowing pipeline and that 10% jump in funded backlog, management lowered their full-year revenue guidance. They dropped it down to between $13.8 billion and $13.95 billion.
Which feels entirely contradictory. They have more money contracted than ever, but they are guiding lower. Where is all this friction coming from?
It's coming from what we call administrative friction. There is roughly $175 million in brand new business awards that Amentum has technically won, but the revenue is just trapped in bureaucratic purgatory.
Bureaucratic purgatory?
Yeah, it's stuck in conversion delays. This is due to post-award contract protests and corrective action timelines across various federal agencies.
Contract protests. This is where the loser of a government bid basically sues to stop the winner from starting work, right?
Exactly. When a federal contract is this massive, the losing companies almost always protest the decision to the Government Accountability Office just as a stall tactic.
You have an example?
Sure. For example, Amentum won the $974 million CMOE-2 contract for NASA's Langley Research Center. And they also won the $500 million Cosmos contract for NASA's Johnson Space Center.
Both huge wins.
Huge wins, but both were protested. Now, the protests were eventually resolved entirely in Amentum's favor, and they kept the awards, but the legal process delayed the actual start of the work by months.
Okay, so they essentially won the lottery, but they are stuck in a bureaucratic waiting room to cash the ticket. It's like winning a bid on your absolute dream house, but you're stuck in escrow hell for 6 months because a title company filed the wrong paperwork. You own the house, it's going to happen, but you just can't move your furniture in and start living there yet.
That is a perfect way to look at it, yes. And the crucial takeaway for anyone analyzing this company is that this is deferred revenue, not lost revenue.
Right, it's still coming.
Exactly. The chief operating officer actually noted that 92% of fiscal year 2027 revenue is already covered by their existing funded backlog or recurring follow-on work. The money is real, the contracts are secured, the timeline has just slid slightly to the right.
Okay, I understand the delayed revenue now.
Yeah.
But it's not just delays holding the top line back,
No.
right? Because they are actually losing or intentionally walking away from specific massive contracts. We need to perform a strict forensic audit of these top line headwinds. Where is the actual revenue leakage coming from?
There are two specific areas dragging down that revenue baseline. First, there is a directive straight from NASA. NASA is implementing a workforce insourcing plan.
Meaning what exactly?
Meaning they are taking certain technical and engineering roles that were previously handled by contractors like Amentum and bringing them in-house to be performed by government civil servants.
Oh, I see. What is the mathematical impact of that NASA directive on Amentum?
It creates a massive 3% revenue drag. We are talking roughly $400 to $420 million in lost revenue, and that's expected to hit in fiscal 2027.
Wait, really? Losing almost $500 million in NASA contracts sounds like a total disaster on paper. If I'm a shareholder, I'm probably panicking right now. Why shouldn't I be?
I completely understand that reaction, but this is where you have to look past the top line. The critical detail here is that this specific NASA work was entirely low to no margin, cost plus pass-through work.
Oh, back to the cost plus thing.
Exactly. Amentum was essentially acting as a staffing agency for them, just processing payroll for a tiny fractional fee. By losing that $400 million in low-margin revenue, their overall profit margin mathematically rises. It is structurally accretive to their consolidated EBITDA margins.
So it's basically addition by subtraction.
Precisely. And they are combining that NASA drag with their own intentional pruning. Amentum is voluntarily making a strategic exit from domestic base operations contracts.
Which are what, like facility maintenance?
Yeah, these are the facility management, grass-cutting, basic logistics contracts on military bases. By walking away from those, they are intentionally shaving another 1% off their total revenue.
But this is the part that genuinely stopped me in my tracks. You mentioned they are shedding base facility management, literally cutting grass and basic logistics, and pointing their workforce at nuclear energy and space systems. How do you transition a workforce like that? I mean, you can't just hand a lawnmower operator a slide rule and ask them to build a nuclear reactor.
You absolutely cannot. And that's why they aren't even trying to do that. What they are doing is bifurcating their workforce.
Okay, how so?
They are letting the lower-tier outsourced labor contracts roll off the books completely. By pruning that dead weight, they free up executive focus, they free up capital, and they free up their existing core of elite engineers.
So they already had the talent.
Right. They are just isolating their world-class talent pool and deploying them exclusively into high-margin fields. It actually masks the fact that the core remaining portfolio, the really advanced engineering work, is experiencing mid-single-digit organic growth.
So where exactly are they pointing that elite engineering talent?
Directly at the two biggest structural tailwinds in the global economy right now, and that is global nuclear energy and critical digital infrastructure.
Oh, man. Let's map out the nuclear side first,
Okay.
because the bookings they're announcing there are just staggering.
In Q3 alone, Amentum booked over $400 million in advanced nuclear design contracts, and they are forming massive global alliances to deploy this technology. Well, they signed a strategic deployment alliance with Westinghouse. That one is focused on building the massive 1 gigawatt AP1000 reactors, while also collaborating to get regulatory licensing for the AP300 small modular reactors, or SMRs.
Wow. And their reach isn't just domestic, is it?
Far from it. They are acting as the global delivery partner for Rolls-Royce SMR units. So they have projects in the UK, they are providing 3 units in Sweden, and they are expanding their footprint into the Czech Republic.
But the absolute crown jewel catalyst, the project that perfectly illustrates this entire corporate transformation, is what they are doing with the Department of Energy at the Savannah River site.
Oh, this is a monumental project.
How?
Amentum was selected by the Department of Energy to act as the lead integrator for a public-private consortium to build something unprecedented.
Unprecedented how?
Well, it is a 1 gigawatt AI data center that will be supported by roughly 2 gigawatts of on-site energy generation. And that's bridging from natural gas to advanced nuclear power.
Just to put that in perspective for you listening, a 1 gigawatt data center is the power equivalent of a small city, dedicated entirely to training artificial intelligence. The anticipated lifecycle revenue for Amentum on this single project is expected to be well in excess of $1 billion.
And this highlights Amentum's unique competitive moat. They operate an asset-light model. In past nuclear cycles, major infrastructure companies literally went bankrupt because they took on fixed-price civil construction liabilities.
For concrete pouring.
Exactly. They were on the hook for pouring concrete, labor strikes, and massive material cost overruns. Amentum doesn't do that. They act as the intellectual prime contractor.
They bring the brains, not the concrete.
Exactly. They handle the licensing, the systems engineering, the complex integration, the safety protocols, and the classified clearances. They avoid all the catastrophic construction risks while capturing the really high-margin intellectual work.
There was one line in the earnings report regarding the Savannah River project that I had to read twice. Amentum is currently negotiating options for economic interest in the eventual commercial operations of that facility, meaning they're negotiating for the monetization of tokens for the AI data centers and the monetization of electrons from the nuclear facility itself.
Which is a phenomenal royalty model.
Right. They aren't just getting paid to build the toll road. They are negotiating to keep a percentage of the tolls forever. So, acting as an intellectual prime contractor generating this kind of high-margin infrastructure revenue brings us to the ultimate question for any financial investigation. What are they doing with all the cash?
Well, let's dissect their structural financial power. Amentum is forecasting full-year free cash flow between $525 and $575 million. Based on their current enterprise value, that represents a highly attractive 9% free cash flow yield.
And for anyone who might not look at free cash flow yield every day, that essentially means if you bought the entire company at its current price, it would generate enough pure cash to pay you back 9% of your investment every single year, just from its operations.
Yeah.
That is an elite cash-generating engine.
And management is deploying that cash aggressively. That generation allowed them to make that $125 million voluntary debt repayment in Q3 we discussed earlier.
Right.
Because of that, they achieved their 3.0 times net leverage target a full quarter ahead of schedule.
Let's define net leverage quickly for you. That is their total debt minus their cash, divided by their EBITDA profit, right?
Yes. And just at the end of fiscal year 24, their leverage was sitting at 4.1 times. So bringing it down to 3.0 times this quickly is a massive de-risking event.
I look at this like paying off a massive student loan. When you're under the crushing weight of that debt, every spare dollar you have just goes to the bank. You are trapped in a penalty box by your debt covenants.
Yeah.
But the day you get your debt-to-income ratio down to a healthy place, the banks let you off the leash. Suddenly you have discretionary income. You can invest, buy a house, or finally treat yourself.
And that corporate playbook is now wide open for Amentum. Achieving sub 3.0x leverage by fiscal year end moves management out of that obligatory debt payoff penalty box. It unlocks total capital allocation flexibility.
So what does that mean practically?
Management signaled they are actively working with the board on strategic options. They can deploy capital toward opportunistic share buybacks, especially if they believe the market is mispricing their stock due to those noisy top-line revenue delays.
Which they probably do.
Right. They can also pursue strategic bolt-on M&A to acquire niche technology firms that enhance their edge AI capabilities. And they can aggressively fund higher return organic growth investments. They control their own financial destiny now.
We've covered a massive amount of ground here. From shedding the low-margin base operations to the escrow hell of GAO contract protests to taking a royalty on a nuclear-powered AI data center. I want you to synthesize everything we've just discussed and deliver a final verdict on the investment case for Amentum.
The final verdict is that the broader market appears to be mispricing Amentum. They are viewing it through the outdated lens of a traditional legacy IT services firm suffering from top-line revenue stagnation.
Which is completely missing the point.
Completely. A forensic audit reveals an enterprise acting as a cycle-resistant, high-margin infrastructure prime. At current valuations, this represents a deeply mispriced structural value play for allocators. Amentum should no longer be viewed as a commodity services firm, but as the unassailable mission engineering backbone for nuclear energy and national security.
But as always on Griffonomics, we define the risk before the reward. Let's look at the hurdles. If I'm an investor, what are the primary execution risks I need to monitor?
We definitely must be clear-eyed about the obstacles. There are three primary execution risks here. First, those persistent administrative award protest delays.
A purgatory we talked about.
Yeah, a $48.2 billion backlog is incredibly impressive. But if that revenue remains trapped in GAO protest cycles for years, the cash flow thesis gets severely delayed.
Right, being stuck in escrow forever doesn't help you build equity. What's the second risk?
Regulatory and licensing timeline bottlenecks. This is specifically in domestic small modular reactor deployments. The Nuclear Regulatory Commission is not exactly known for moving at the speed of Silicon Valley.
Fair point.
Any delays in greenlighting SMR technology directly impacts Amentum's long-term growth timeline in that sector.
And the third risk ties right back to the government funding mechanism itself, doesn't it?
Exactly. Potential government contracting friction under federal continuing resolutions. When Congress cannot pass a formal budget and relies on stopgap funding, new program funding essentially freezes. That could severely stall the conversion of Amentum's unfunded backlog into funded, actionable revenue.
So there are real speed bumps on this transition road.
Without a doubt. But the underlying destination they are driving toward is incredibly compelling, which brings me to a final provocative thought for you to mull over.
Let's hear it.
The global race for artificial intelligence supremacy, this massive race between the hyperscalers, is no longer gated by algorithms or the supply of silicon chips. It is completely gated by access to advanced nuclear baseload power.
Yep.
You simply cannot run a 1 gigawatt AI data center reliably on wind and solar alone.
No, you need continuous, massive, carbon-free baseload power, 24 hours a day, 7 days a week.
Yes. So as these hyperscalers desperately search for energy to train their models, will traditional tech investors soon realize that the entire future of the AI revolution is completely dependent on legacy government contractors like Amentum?
That is a wild thought.
Think about it. These are the only entities on the planet with the classified security clearances, the decades of specialized nuclear regulatory expertise, and the complex integration moats required to actually build the physical AI future. Without them, the AI revolution simply runs out of power.
That brings us right back to our opening thought. You step into the world of Amentum, and suddenly, the simple diagnostic test of looking at top-line revenue just doesn't work anymore. You have to look at the structural, unassailable foundation they are building beneath the surface. Thank you for joining us on this deep dive. Keep looking beneath the headline numbers, and we'll see you next time.